4 days ago, India implemented export restrictions on silver. Not a ban, not yet, but a licensing system so restrictive that it effectively halts silver leaving the country. And buried in the notifications from the Directorate General of Foreign Trade was a date that should alarm anyone paying attention to global silver markets. April 1st, 2025. That's when the restrictions become absolute. India isn't just another player in the silver market. India is the second largest importer of silver on Earth, consuming over 200 million ounces annually, nearly a quarter of total global mine production. And India just announced that after April 1st, silver exports will require explicit government approval on a case-by-case basis, which in practice means no exports at all. Let me be very clear about what this means. 1.4 billion Indians, plus the billion-plus people in neighboring countries that depend on India as a regional trading hub, just lost unrestricted access to global silver markets. The Indian government has effectively trapped 200-plus million ounces of annual silver demand inside the country, and the second-order effects on global supply are going to be catastrophic. This isn't about India protecting a strategic resource for national security. This is about India preparing for a monetary crisis that the government can see coming but hasn't announced publicly. And when a country of 1.4 billion people with deep cultural affinity for precious metals decides to lock down silver supply, that's not a policy adjustment. That's a warning shot. Let me show you exactly why India did this, what it reveals about the global silver market, and what happens when the world's hungriest silver market suddenly goes dark to exporters. Here's the framework for understanding India's relationship with silver, because this goes back thousands of years and is embedded in the culture in ways Westerners struggle to comprehend. Silver in India isn't just an investment or industrial material. It's woven into religious practice, marriage customs, savings culture, and social status. Hindu weddings traditionally involve gifting silver jewelry and coins. It's considered auspicious and represents the transfer of wealth between families. Religious festivals like Diwali see massive silver purchases as offerings and gifts. For hundreds of millions of Indians who don't have access to formal banking or don't trust the banking system, physical silver is how you save money. You take your rupees, buy silver jewelry or bars from the local jeweler, and that's your savings account. When you need cash, you sell the silver back. It's simple, it's liquid, and it has thousands of years of cultural validation. This means India has structural silver demand that doesn't fluctuate with investment trends or industrial cycles. Indians buy silver when times are good because they have money to save. They buy silver when times are bad because they don't trust anything else. The demand is constant and enormous. India imports between 180 million and 240 million ounces of silver every single year, depending on economic conditions and harvest seasons. During a good monsoon when farmers have cash, silver imports spike. During wedding season, which in India can involve millions of weddings in a matter of weeks, silver demand goes parabolic. And here's the critical detail. India produces almost no silver domestically, maybe 1 to 2 million ounces per year from a handful of small mines. Everything else is imported primarily from Peru, Mexico, Australia, and the Middle East via Dubai. So when India implements export restrictions, they're not protecting domestic production, they're trapping imports. Silver flows into India and cannot flow back out. It's a one-way valve that just closed. Now let me show you what actually happened in the last 2 weeks because the policy implementation was sudden and the justification was revealing. On March 15th, 2025, the Indian government's Directorate General of Foreign Trade issued notification number 12/2025, moving silver from the free export category to the restricted category. This means any entity wanting to export silver from India now needs explicit government authorization for each shipment. The notification cited ensuring adequate domestic availability and strategic resource management as justifications. No mention of national security, no mention of defense applications. Just vague language about domestic availability, which is bureaucratic code for we're worried about supply. Then on March 20th, a follow-up notification clarified that the restrictions would be fully enforced starting April 1st, 2025. After that date, all silver export applications would be reviewed by an interministerial committee with no guaranteed approval timeline. In other words, frozen. India has done this before with other commodities, wheat, rice, sugar, when domestic prices spiked and the government feared inflation or shortages. But silver is different. You can grow more wheat next season. You can't mine more silver on short notice. And India's silver consumption isn't about food security, it's about financial security. The fact that the government felt compelled to lock down silver exports tells you they see something coming that requires Indians to have maximum access to physical precious metals, and they're willing to disrupt global markets to ensure that access. So what are they seeing? Let me show you the data that explains the panic. The Indian rupee has been under sustained pressure. Against the dollar, the rupee has weakened from around 74 rupees per dollar in 2021 to over 83 rupees per dollar by early 2025. That's an 11% depreciation in 4 years. For a country that imports most of its energy, commodities, and yes, silver, currency depreciation means inflation. And inflation in India has been running hot. Official CPI inflation has been averaging 6% to 7%, but food inflation, which matters most to the 70% of Indians who spend the majority of their income on food, has spiked above 10% repeatedly. In this environment, Indians do what they've always done. They buy gold and silver to protect their purchasing power. Demand for precious metals in India surged in 2023 and 2024 as people fled the rupee. But here's the problem for the government. Every ounce of gold or silver imported into India requires dollars. India's trade deficit, the gap between imports and exports, has been widening. In fiscal year 2024, India ran a trade deficit of over $250 billion. Precious metals imports, while not the largest component, still represent $30 to $40 billion of that deficit. When the rupee weakens and Indians respond by buying more gold and silver, it creates a vicious cycle. More precious metals imports require more dollars, which increases demand for dollars, which weakens the rupee further, which causes Indians to buy even more gold and silver as protection. The Reserve Bank of India, the central bank, has been burning through foreign exchange reserves to support the rupee. India's forex reserves peaked at $645 billion in 2021. By early 2025, they'd fallen to around $620 billion. That's still substantial, but the trajectory is wrong. And the RBI knows that if a crisis hits, $620 billion can evaporate quickly. So the government looked at the situation and made a calculation. We cannot afford to let silver flow back out of the country. We need to trap every ounce that comes in to ensure domestic supply and reduce the pressure on our forex reserves. The export restrictions are a capital control by another name. And capital controls are what governments implement when they're preparing for currency crisis. Now let me show you what this does to global silver supply because the numbers are brutal. India imports roughly 200 million ounces of silver per year. That silver comes from global production, which totals about 1 billion ounces annually from mining and recycling combined. Under normal circumstances, a significant portion of the silver imported to India eventually gets recycled and re-exported. Old jewelry gets melted down, refined, and sold back into international markets. Scrap silver from industrial users in India flows back out. Estimates suggest that 30 to 50 million ounces of silver per year used to flow out of India through recycling and re-export. That flow just stopped. After April 1st, that 30 to 50 million ounces per year stays in India. It gets absorbed into jewelry, hoarding, or industrial use and doesn't return to global markets. So effectively, India just removed 30 to 50 million ounces of annual supply from the global market. That's 3% to 5% of total world supply gone overnight. In a market that's already in deficit, where industrial and investment demand exceeds new mine production by an estimated 150 to 200 million ounces annually, removing another 30 to 50 million ounces of recycled supply is catastrophic. Where does that supply come from instead? There's no easy answer. You can't just produce more silver. Mining output is relatively fixed in the short term. Recycling in other countries can't instantly scale up to replace Indian flows. The The result is that the global silver market just got 3% to 5% tighter. Prices have to rise to ration demand, and every industrial user, investor, and government that needs silver is now competing for a smaller pool of available metal. But here's where it gets even more interesting. Because India's move is almost certainly coordinated with other policies happening across Asia that suggest a broader strategy. China implemented informal silver export restrictions in late 2024. Not official bans, but administrative guidance that makes it difficult for Chinese companies to export silver. Customs delays, export license scrutiny, sudden environmental inspections of refineries, all of which slow or stop silver exports without formal announcements. Why would China restrict silver exports when they're a major producer? Because China is also a massive consumer, and Chinese industrial planners see the same supply deficit that India sees. They want to keep silver inside China for their own solar panel production, electronics manufacturing, and strategic stockpiles. Russia has reduced silver exports to Western countries since 2022 sanctions, redirecting supply to China and other non-Western buyers. Russian silver production of about 45 million ounces per year used to flow freely to global markets. Now it's captive to the Eastern Bloc. Saudi Arabia and UAE, major silver consumers and trading hubs, have reportedly been accumulating silver for sovereign reserves, reducing the amount available for re-export from the Middle East. You're watching a coordinated, if informal, strategy by non-Western countries to lock down silver supply within their spheres of influence. India's export restrictions are just the latest and most dramatic move in that strategy, and it's happening for the same reason across all these countries. They see a monetary reset coming where gold and silver become critical to backing currencies or trade settlement systems, and they're making sure they have the metal before the transition occurs. Now let me show you the second-order effects, because this isn't just about supply. This is about trust in the financial system. When India restricts silver exports, it sends a signal to every Indian citizen. The government is worried about availability. Even if officials don't say it explicitly, the policy itself communicates fear of shortage. And how do Indians respond when they think there might be a silver shortage? They buy more silver, immediately, before restrictions get tighter or prices spike further. This is the paradox of capital controls and export bans. They're meant to preserve supply, but they trigger hoarding behavior that consumes supply faster. The announcement of restrictions causes the very shortage the restrictions were meant to prevent. Reports from jewelers in Mumbai, Delhi, and other major cities indicate that silver purchases spiked dramatically in the days after the export restriction announcement. People who were planning to buy silver next month bought it today. People who weren't planning to buy silver at all decided they should have some, just in case. The Indian government just created panic buying in a market of 1.4 billion people with cultural predisposition to hoard precious metals. The domestic Indian silver market is going to get extremely tight, extremely fast, and that tightness will force India to import even more silver to satisfy domestic demand, which defeats the purpose of the export restrictions in terms of managing the trade deficit. India wanted to reduce forex outflows by trapping silver domestically. Instead, they've increased domestic demand, which requires more imports, which requires more dollars. It's a policy own goal, but it's the predictable result of trying to control markets that operate on fear and cultural behavior patterns rather than rational economics. Now let's talk about what this means for the rest of the world, because India's silver market doesn't exist in isolation. The Middle East, particularly Dubai, has historically acted as a trading hub where silver flows from producers to India. Refineries in Switzerland and the UAE process silver into forms acceptable to Indian buyers. That entire trade infrastructure just lost its primary customer for re-export. What happens to the silver that used to flow through Dubai to India? Some of it will still go to India directly as imports, but the recycled silver that used to come back out of India and get redistributed globally through Dubai? That's gone. Dubai's silver market is about to contract significantly. China, which also imports significant silver, will now face reduced competition from India for certain supply streams but increased competition for others. The dynamic is complex, but the net effect is tighter global markets and higher prices. Western industrial users, solar panel manufacturers, electronics companies, military contractors, are going to face higher prices and longer delivery times as available. Silver gets bid up by buyers scrambling to secure supply before more countries implement restrictions. Silver ETFs like SLV, which need to buy physical silver to back new shares when investors pile in, will struggle to source metal. If Indian recycling supplied 30 to 50 million ounces per year to global markets and that disappears, where do the ETFs get silver when inflows spike? The answer is they either pay massive premiums to pull silver out of industrial inventories or other private hands, or they suspend share creation and go to premiums over NAV, signaling that paper silver and physical silver are decoupling. We're already seeing that decoupling in Dubai and Singapore, where physical premiums are 25% to 30% over COMEX spot. India's export restrictions are going to accelerate that decoupling. Now here's the critical question. What happens if other countries follow India's example? Indonesia is a major tin producer that also produces silver as a byproduct. If Indonesia decides it wants to keep silver for domestic electronics manufacturing and implements export restrictions, that's another 30+ million ounces of supply locked up. Mexico produces 190 million ounces of silver per year, the most of any country. Mexico exports most of that production to the United States and globally. But if Mexico sees what India did and decides it wants to preserve silver for domestic industrial use or strategic reserves, and implements similar export restrictions, the global market doesn't just tighten, it collapses. Suddenly you'd have 190 million ounces of Mexican production, 110 million ounces of Chinese production, and 30 to 50 million ounces of Indian recycling. Over 330 million ounces total, or 1/3 of global supply, trapped in 3 countries. The remaining 670 million ounces of global production would have to satisfy all of Europe, the United States, Japan, South Korea, and every other country in the world. The price would go ballistic. $100 per ounce would be a floor, not a ceiling. Is that likely? I don't know. But 6 months ago, nobody predicted India would implement silver export restrictions. These policies are being made in response to rapidly changing economic conditions and fears about monetary stability. If India sees a benefit to locking down silver, other countries will notice. And resource nationalism, the tendency of countries to hoard strategic materials during times of economic or geopolitical stress, is on the rise globally. We saw it with rare earths. We saw it with wheat and fertilizer after the Ukraine war started. We're seeing it now with silver. And once the dominoes start falling, they fall fast. Let me show you what the policy options are for Western governments, because they're all bad. Option 1. Do nothing and hope markets adjust. Prices rise, demand gets rationed, industrial users substitute other materials where possible. This is the free market approach, but it risks severe disruptions to supply chains in strategic industries like solar, defense, and electronics. Option 2. Implement export restrictions of our own. The United States could ban silver exports to preserve domestic supply for industrial and military use. But this would further fragment global markets, trigger retaliation, and accelerate the breakdown of the globalized trading system. Option 3. Negotiate with India to reverse the restrictions. Offer trade concessions, diplomatic support, or financial assistance in exchange for reopening silver exports. This is politically difficult and may not work if India's motivations are based on genuine fear of monetary crisis. Option 4. Release strategic reserves. The U.S. has 31 million ounces in the Defense National Stockpile. Releasing that to stabilize markets would ease short-term pressure but leave the U.S. vulnerable to long-term supply disruptions, especially in a conflict scenario. None of these options address the fundamental problem. Global silver supply is inelastic in the short term. Demand is accelerating from both industrial and monetary sources, and countries are beginning to hoard rather than trade. This is the early stage of a supply crisis that could take years to resolve, even under the best circumstances. And if more countries follow India's lead, it won't resolve at all. It will just reorganize into regional blocks where silver trades within spheres of influence but not between them. The globalized silver market, where metal flows freely to wherever demand is highest, is ending. We're moving into a fragmented world where silver is treated as a strategic asset to be controlled rather than a commodity to be traded. Let me show you what this looks like for individual actors in the market, because the implications are different depending on who you are. If you're an industrial user of silver in the West, you need to secure long-term supply contracts immediately. Waiting to see how this plays out could mean finding yourself unable to source silver at any price 6 months from now. Every day you delay gives competitors a chance to lock up supply before you do. If you're an investor holding paper silver, futures contracts, unallocated accounts, or even ETF shares, you need to understand that your claim on physical silver just became less reliable. If a delivery crisis happens because global supply is fragmented and locked down by export restrictions, your paper contract might settle in cash at the official price, while physical metal trades at multiples of that price. If you're a mining company producing silver, you just saw your product become more valuable and more politically sensitive. Expect governments to start pressuring you about where you sell your production. Export licenses that were automatic will start requiring approval. Your business just became geopolitical. If you're a government official responsible for strategic reserves or industrial policy, you're probably in emergency meetings right now trying to figure out how to secure supply before more countries implement restrictions. And if you're an ordinary person trying to preserve wealth, you're watching governments around the world signal through their actions that they don't trust the stability of the current monetary system and are hoarding tangible assets as insurance. Look, I'm not a financial advisor. I don't know your personal situation. I'm not telling you to buy silver or sell anything. I'm showing you that India, a country of 1.4 billion people that imports a quarter of global silver production, just implemented export restrictions that remove 30 to 50 million ounces of recycled supply from global markets starting April 1st. That's a week away. And when that policy takes effect, the global silver market will be structurally tighter than it's been in decades, possibly ever. The Indian government didn't do this on a whim. They did it because they see risks to currency stability and monetary confidence that require preserving access to precious metals for their population. When countries start hoarding strategic resources, it's not because they're confident in the future. It's because they're preparing for instability. And when a country the size of India makes that decision about silver, it's a signal that instability is closer than most people realize. April 1st isn't just an arbitrary deadline. It's the day the global silver market fragments, and once fragmentation starts, it doesn't reverse easily. The question isn't whether silver prices will rise, the question is whether you'll be able to access physical silver at any price once countries finish locking down their supplies. And based on what India just did, the answer to that question is becoming increasingly uncertain.